Hello and welcome to another episode of Darwin Investors. Yeah, I took a few weeks off from recording videos. It felt pretty good. Spent some more time, quality time with the wife and the family and stuff. I'm doing something a little bit different. I did make these videos every single weekend for about 9 months in a row. Um, but today is my birthday, so I'm going to do what I want to. But unfortunately, given the state of today's stock market conditions, this might be a pretty ugly video, so you may want to get the kids out of the room. But yeah, before we get started, let me go ahead and get a quick shout out to my sponsor. Guys, have you ever started a YouTube stock market channel right in the beginning of an entire global financial crisis and you need a little bit of something to dull the pain? Man, I have. And have I ever got the product for you? It's whole six-pack of beer. Let's just see if it works. I can feel the pain going away already. All right, let's get into this. Now, I used to be a little bit more of a Fed apologist once upon a time, like up until about 2 or 3 weeks ago. And the reason why was because, the pandemic wasn't their fault. They had nothing to do with that, and they had nothing to do with the government like pumping the economy full of all this stimulus money, and that was born of government spending that was sort of like thought up to been a necessity to keep our economy rolling. And as it turns out, a lot of people that were receiving these stimulus checks didn't need them at all. Instead, they were like starting brokerage accounts or buying iPhones with that money, not necessarily paying their utilities and buying groceries with that money. And so none of that was their fault. Where they do start getting a little bit of blame, however, though, is, like buying back mortgage-backed securities in like March of this year when the housing market was screaming at an all-time high. And I think at the same time they were buying back US Treasuries, which was pumping more liquidity into the market, which was causing even more inflationary pressures. And yeah, that was their fault. And so right now they're feeling a lot of pressure to kind of undo that terrible policy making decision that they were making back earlier this year. In doing so, I fear that they're hiking the rates up so it isn't that they're hiking them up so high, but they're hiking them up so fast that it's breaking a lot of like global market conditions. And judging by the latest summary of economic projections, it doesn't seem like they're planning on cutting back on these rate hikes anytime soon, even though, who knows if you can believe what these guys say anymore. So at the latest FOMC meeting, the Fed released their summary of economic projections for the federal funds rate, and they're showing that at the end of 2022, it's going to be at 4.4%, which is expected to go up to 4.6% at the end of 2023 before it U-turns, comes back down to 3.9% in 2024 and 2.9% in 2025. Now, whether you choose to believe this or not, and I think most people don't, because they've changed this so many times in the last 6 months, but whether you choose us to believe this or not, it looks like they do plan, however, on hiking pretty significantly by the end of the year, because we're currently sitting at 3% to 3.25%. So there's two more FOMC meetings scheduled between now and the end of the year, so it would stand a reason that they're going to try and hike at 75 basis points at one meeting and 50 at another. And that's what the market's actually pricing in right now. And so if you look at that, getting us up to 4.4% or even 4.6% isn't historically very high. You can see that's pretty low. But what the problem is this rate of increase. So it's not the terminal rate that's the problem. And I think they were thinking, well, we're only going to get it up to 4.6%. That's not that bad. And we'll just get it there as fast as we can to crush inflation. Well, what they're failed to recognize was the impact that the rate of increase would have not only on our own economy, but on economies around the world. So if you look over here at, say, the United Kingdom, you're going to see this was big news earlier on in the week, where the rate of the British 10-year gilt, that would be their bond, the 10-year bond, their 10-year gilt went up in dramatic fashion, where it was in December of last year, it was sitting at 0.73%, and now it's up over 4%. It actually spiked up to here. And the reason why it spiked up that way was because the UK is having like about 10% inflation, and the government decided they would go ahead and cut taxes to stimulate the economy, which would then turn around and create more inflation. And that caused a bit of a panic, and it caused a lot of people to sell off their bonds. More bonds in the market means that the yields will go up, but that means that the price of a bond or a gilt actually goes down. And where that was a problem was because England puts a lot of their pension funds are in the form of these gilts, and a lot of these gilts are actually bought on leverage. They're borrowed money to pay for pension funds for retirees in England. And so by selling off all of these gilts, pension funds were drying up in England. So the Bank of England had to step in and buy long-term bonds, because when they're buying the bonds, that's going to drive the yield down, but the price of the bond up. And that's what's happening. So basically the yield went up so fast that the bond price or the gilt price crashed. And that gilt price crashing hurt pensioners in England. So the Bank of England had to step in and fix this. Now, I'm afraid we're having a little bit of this problem, or could have a little bit of this problem here, not necessarily in our bonds crashing pensions, although I know that I'm not sure that they won't. And despite the problem that these spiking interest rates are having at home and all around the world, the Fed just seems very concerned about protecting their own credibility. Like, they're ignoring all the data coming in, and the only thing they seem to care about is this credibility. And the only thing that can bring down inflation is higher unemployment. It's as if they don't understand that high unemployment causes inflation. It's inflationary because high unemployment creates less supply. It creates more government stimulus. And what concerns me is they apparently don't seem to know this, because they're going on television, like, I don't know how many times a week. They might as well start their own dang YouTube channel, but going on television, I don't know how many times a week, to talk about how they got to crank up unemployment to bring down inflation. And none of that makes sense to me. What they should be doing is looking at the data and looking forward, but that doesn't seem to be one of their strengths. When you look at the data, you're seeing that the commodity complex is actually coming down. That's pretty evident every time you go to a gas pump. Maybe they should take a drive somewhere and figure this out, or maybe go down to Lowe's or Home Depot and try and buy some lumber or some copper. They would be able to easily figure this out. This is very easily to empirically figure out, but they don't seem to be doing it. Instead, they're like, well, we're going to crash it down. We got the housing affordability index that's now crashing, like right here. So what's the housing affordability index? Well, an index above 100 signifies that families earning the median income have more than enough income to qualify for a mortgage loan on a median priced home, assuming a 20% down payment. Now, if you look at this, houses haven't been this unaffordable since about 2006. Let me go ahead and make this a little bit bigger. Since about 2006. And so, and it's actually back down to where it was in 1990. And this came clear down here because if you're cranking up interest rates really, really fast and home prices are still really, really high, you're going to have less home affordability. They're ignoring this FedEx right here. It's like FedEx. It's like, that's not the canary in the coal mine. They are the coal mine. They bring the canary to the coal mine. You might think, well, a canary could just fly to the coal mine. No, they would rather just take FedEx. FedEx shares were down about 21% in one day. They announced significant cost-cutting measures, and they're going to close 90 offices in 5 corporate locations and defer hiring. They're not looking at this sort of thing. The global economy is slowing down. They need to get a hold of it. And the truth is, it wouldn't matter even if they, it's like bad news is bad news and good news is bad news. If they had turned around, instead of saying that everything is crashing, instead they said, we're going to open up 90 more offices and 5 more corporate locations. We got to buy 150 more jets and we got to hire 10,000 more people. Do you know what the Fed would have said? Oh my gosh, we got to higher interest rates even higher because FedEx is going up. So it didn't really matter what direction this was going in. Bad news is bad news and good news is bad news. But I digress. So now we look at, say, Nike. They just put out their cue that things are slowing down globally as they have like 44% more inventory than they can get rid of. You got Micron. And by the way, this is a window into what earnings are going to look like coming up on us here. Micron's earnings, they beat on revenue, and they beat on earnings, a slight miss on revenue, but they did a light guidance. These are things that we can expect to have. This will be a theme throughout this earnings season, I predict. These are things that the Fed could look at. We also got slowing in hiring, if not actual outright job cutting in a lot of businesses. I mean, it's really clear that we have declining growth numbers, not just in America, but all over the world. This should be really evident to them, but no, instead they want to crash this economy right into the side of the mountain out of pride and because some ridiculous hero worship over some jackass named Paul Volcker. And they said they were going to be data dependent, and I believed them. I was like, okay, well, I like the Fed. They're going to be data dependent. Let's just see what they do. And I think a lot of people believed that they would be data dependent. The problem was we didn't think that their data was going to be past data. We thought they were going to look forward and see that data instead. It's sort of like you're driving down the street with your buddy, and you're in your car, and then you hit a pothole and you pop two tires on the left side of your car, and it's like you get on the other side of the pothole and your buddy's like, hey, there was a pothole back there, and you're like, thanks, useless. And the problem that we're having as investors is a lot of this we're on our own because people don't care about us really. I mean, this is likened a lot to the 2000 crash. I think it's a lot like 2000, and it's also a lot like 2007, the financial crisis. And I'll show you how I believe that's kind of playing out in a different way. I'm not seeing a housing bubble burst or banks going out of business or anything like that, but I am seeing elements of it that are kind of creeping in. And I can see where someone might start making the comparison to the 2008 financial crisis here fairly soon. And so in 2000, remember there was the big bubble, and I remember that crashed. And unless you were in sort of like in the stock market, or unless you were in a tech computer job, you weren't too concerned with the economy at that time. In 2000, I was a computer programmer. I used to make front-end database applications using proprietary language. It was very syntactically very similar to, say, Visual C++. And I also make some web integrated, like interactive web applications using a programming language called ASP, which was very similar syntactically to Visual Basic. And this is what I was doing back then, and I moved on the campus of Microsoft to try and either get a job in there or get into dental school. And then and I really just wanted the stability of being a dentist over being a computer programmer, because at that time we were like being fired left, right, and center, and that was the only people that really cared about this 2000s recession or the market crash back then. And I feel like that we're kind of in the same boat now. The only people that really care about this crash right now are people in the market and people that are in tech jobs, but they're pretty much being hung out to dry at this moment. It's sort of like deja vu all over again. But what I'm afraid of is what's going to happen is going to become a little bit more like 2007, 2008. And in that market crash, that one was a whole lot different. And the reason why that one was different is because a lot more people cared about that stock market crash. It had to do with 10% unemployment rate. And so when we're over here in the year 2000, and you can see the unemployment rate here was sitting right around 4%. The only people that were scared were us programmers. But even when it did creep up, it didn't creep up, to some historically crazy high level like it did in 2008, where it got up to over 10%, only to have interest rates be cut, slashed, stimulate the economy again, and bring the unemployment rate down over the next 11 years down to about 4%. And so this will actually get people's attention. And this is what I'm afraid we're headed for. And the reason why I think we're headed there has to do with the bond market and the TINA trade. Or rather, it's the end of the TINA trade, which is basically people are starting to buy bonds. And we're finding out more and more. It's sort of like when you watch television, you see that commercial and then there's that show in between. Well, really, that show is the commercial. You just think it's the show that you're watching, but really what's keeping that thing going is those commercials. And so that's the same with the equity market. The only thing that's keeping the equity market going is that people don't want to buy bonds. So the show is really the bond market, and the equity market is really the other thing that just kind of like happens if no one wants to buy bonds. Now, most bonds are great and they're worthy investments. And if you're willing to have a small return and you want to do it risk-free, they're a great way to go. And a lot of bonds are very good, and provided that you don't mind a really, really tiny return on your investment over the next 2 to 10 years, because you just really want to be safe. And let's say that you're a huge bank like Goldman Sachs, and you just want to buy a bunch of bonds because you want to be as safe as humanly possible and get at least some return without any risk. And those bonds are really good. But there's a lot of stuff out there called junk bonds, and what they are is basically like subprime variable rate corporate loans. And those are the scary ones. And these are the ones that could eventually affect our financial markets. So it's not really the housing market that I'm worried about right now, because there aren't that many subprime loans out there. However, there are lots and lots of subprime variable rate corporate loans out there in the form of junk bonds. And I'm afraid that if they keep raising the rates a lot higher, a lot of investment grade bonds could eventually turn into junk bonds if they keep their foot on the gas. And so I know I threw out a whole bunch of words right there in like rapid fire succession. And so let me go ahead and slow it down a little bit and just kind of show you why I might be concerned that we might be creating a little bit like a mini version of the 2007, 2008 housing crisis with respect to corporate bonds. Now, corporate bonds are the highest yielding of all bonds, and they come out ahead of treasury bonds and ahead of federal government and municipal bonds issued by state and local governments. So they're the highest yielding of the bonds, which is what makes them so enticing. And they're also going to be considered to be less risky than just investing in straight equities. However, corporate bonds are a little bit different. If you have a fixed rate corporate bond and you invest $1,000 in a 10-year bond paying a 3% fixed interest, the company will pay you $30 a year. And this would be an investment grade corporate bond that has a fixed rate. But also out there is what's called a floating rate bond. And these have variable interest rates that change based on benchmarks such as the US Treasury rate. So if the US Treasury spikes really high, just like it is right now, these companies that sold these bonds are having to pay back this new interest rate, not the 0% or 0.5% that they borrowed a long time ago, but rather the 4% or 5% that they're going to have to pay back now. These companies that issue these are usually issued by companies considered below investment grade, i.e. those that are considered junk bonds. So these are highly leveraged companies that are selling these bonds at one lower percentage rate, only having to pay them back later at a higher interest rate. And some of these companies might not be able to pay these back. And these are what's called zombie companies, companies that issue bonds that they can no longer pay the interest rate, let alone pay you back your original investment. These are called zombie companies. And that's what low interest rates do. They prop up zombie companies. These subprime floating rate bonds is what I'm concerned might lead to a bit of a financial crisis. So I wanted to see who's actually holding on to the bonds that have been issued by companies considered below investment grade with variable interest rates and a spiking interest rate environment. Because to me, this is kind of a recipe for disaster. So I go over here and I look at the floating rate bonds ETF list, and I can see that iShares has one here called FLOT. If I go over here and I look up FLOT, I see that I can buy this basically junk bond ETF for $50.27. However, the companies that are in this ETF are not the actual companies that are selling the bonds. It's the companies that are buying the bonds. And the people buying the bonds are Goldman Sachs, Morgan Stanley, HSBC, JP Morgan, again, Morgan Stanley, Wells Fargo. I think you get the point. If I look at FLTR, that would be for floating rate ETF for VanEck. Look at FLTR and see who there is in there. You got Verizon, but again, you got Goldman, Bank of America, Morgan Stanley, Goldman, Truist, Capital One. You get the point. A lot of banks are holding these junk bonds. Now, if the rates rise so high that these companies cannot pay back these interest rates, let alone the original loan that was given to them in the first place, you're going to have a lot of banks that are going to basically default on a lot of these loans. And so who are the companies that are part of this junk bond complex? Well, it looks like here the holdings in this one would be like Caesars Entertainment, AA Advantage, Carnival Cruise Lines, American Airlines, and so forth. A lot of these are very highly leveraged companies that could probably barely afford to pay the interest rate when it was low, and now that they're having to pay it when it's a much, much higher is going to be a bigger problem for them. Now, the problem that I fear is that you're going to take some companies that were kind of on the border between being investment grade and basically junk grade, and turn some of these investment grade into junk grade. So a lot of these bonds could be defaulted on by companies that were previously thought of to be investment grade because the rates spiked so quickly, and that could cause a big problem for the banks. So let's go ahead and talk about inflation data for a minute. So on October 13th, there's going to be a new CPI print that's going to be released. And the expectation is for 8.3% year-on-year inflation, which is actually be exactly the same as last month, 8.3%. The month before that, it was 8.5% year on year. And the month before that, it was 9.1% year on year. Now, well, ideally, we would expect this, we would hope for this number to come down, down, down. And in fact, the consensus has is at 8.1%. But let's go ahead and just go with this 8.3% and find out what that would mean month over month increase in inflation. Now, last month, the number was 295.620. And if you divide that number by 273.092, you get the 8.3% inflation, or 8.249% inflation that they have, or 8.3% year over year. You can see that this number is very flat from here to here, so it wouldn't take much to push this, to make it even or push it up. However, it's very steep between there and there. We would expect that inflation would peak in June of 2023, or at least that would be the biggest decrease would be by June of 2023. Whatever we're sitting in at June of 2023, it's going to be very hard to make that inflation rate come down in any appreciable way, unless of course this line here spikes up. But I would expect that this is going to be flat or probably come down at least through June of next year. But for the time being, between August and September, this line is fairly flat. So if we look at the 8.3% that they're projecting month over month, we would take this number here, the September number, 274.214, and multiply that by 1.083, and that gives us 296.97, and divide that by the latest number here, 295.620, and that would mean that month on month, we're expecting 4.579, or where they're going to round it up to 5.5% month-on-month inflation. So 0.5, I mean, sure, it could be that. I mean, it could be higher. Who knows? And remember, this number here, this 8.3, it includes everything. It includes energy. It includes everything. So what they're, I guess, banking on is this shelter number is going to be really red hot to keep this number up to 0.5%. So let's say instead of going up 0.5% month over month, it only goes up 0.3% month over month. So we would take this number here, 295.620, multiply that by 1.003, that gets us 296.5, and divide that by this month here, 274.214, and that would get us 8.12, or they would round it down to 8.1% inflation. 8.1% inflation would bring us right here to the consensus. And I don't think that that's unreasonable to get us down to 8.1%. Now, is that going to satisfy the Fed? No. Is it going to satisfy the market? Probably not. It's going to be basically, by the time October 13th rolls around, that's going to be what's expected, maybe even 8.0 or 7.9. It remains to be seen. So what actually had the market spooked this week? Well, it was on the inflation side, it was that this PCE data actually came in showing that inflation accelerated more than what was expected. So when we look at this data here, we can see that PCE went from 6.4 to 6.2. Now the market was hoping or expecting 6.0, they got 6.2. For PCE, excluding food and energy, they were expecting it to maintain at 4.7. Instead, they went up to 4.9. Again, in fine Fed fashion, they would look at this and say, oh, this is really, really awful. Because if we're doing PCE minus food and energy, the bulk of this is going to come from shelter. It's going to come from home prices. It's going to come from rent. But when you look at this data on home prices right now, home prices have been decelerating by record amount, according to a new report. This came out on September 28th. When we look at rent prices, rent is finally showing signs of cooling down. This came out on September 13th of 2022. But the Fed doesn't look at stuff like this. They're not forward looking. They're backwards looking. So these are the sorts of things that they would ignore and instead decide to go ahead and crank up those interest rates as high as humanly possible to try and get it to their 4.4 by the end of the year to keep their credibility. So what can we do today as equity investors? I know I've given a lot of bad news, but where can we go from here? Well, my advice is to keep it really, really simple at this time. Maybe you want to go into bonds. I mean, get a little bit of a yield on that 2-year. Maybe you do want to get some investment grade corporate bonds, municipal bonds. Maybe you want to just pull it out and just sit this out. I don't know what the answer is, but I'll tell you what I'm going to do. I'm just investing in really high grade stocks, and that's similar to what this Depression era fund did back in 1929. And this fund is actually outperforming the S&P 500 just by doing nothing. And of course, all that means is they're down less than like 20-something%. But this 87-year-old mutual fund formed in the depths of the Great Depression has beaten the S&P 500 this year just by doing nothing. And it's called the Voya Corporate Leaders Trust Fund, which was first established in 1935 as a concentrated portfolio of 30 blue chip companies that were considered unlikely to go bankrupt. And that was a vital concern after the 1929 crash when there was an entire global slump. And that's what I'm doing now, is just investing in companies that I believe are very unlikely to go bankrupt on the other side of this. And then with those companies, just selling covered calls against these underlyings. And so if you look at the week that I had last week, you can see that from the 26th of September through the 1st of October, which is today, made $573 last week just selling covered calls. Now, this isn't something that I normally do, is sell covered calls against my underlying that are currently trading at all-time lows, but unfortunately that just does seem to be the market that we're in. I'm going to do it again next week and we'll just see what happens. I do this for you, world, because if I do this, it's definitely going to go backwards. My stocks that I hold now are Adobe, AMD, Amazon, Applied Materials, JP Morgan, Lowe's, Microsoft, Nvidia. I also own Google and I own Polestar as my spec play. And if you look at year to date, my return has been $9,297 I made this year. That's actually down. I was at one time up about 12,000. So I'm down about 2,800 from where I was because I lost a lot of money selling puts. I don't advise selling puts at this time. At least I'm not going to do it because it's more than burned me. I have another 80 or so dollars coming out of Google covered calls unless it really spikes high on Monday. But then I'm going to sell my covered calls again. So I'm doing it on very conservative plays that I think that on companies that I don't believe are going to go out of business. And that's what I'm doing. I'm basically holding a portfolio of very conservative stocks. I'm selling covered calls against the underlying. I'm basically in companies that I don't think are going to go bankrupt. They're going to be able to weather this storm and I should come out ahead on the other side. And that's what I'm doing. So if you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. I hope it's a cheerier video next time. We'll see you next time. Have a good day. Bye.